All right, everybody. Last week we had all of the Canadian banks report earnings, and in this week's video, I want to go over what I feel is the weakest performing Canadian bank right now, and the one that has by far the most headwinds moving forward, and that is TD Bank. So, full disclosure, I ended up selling TD Bank back when the anti-money laundering issues started surfacing in the latter part of 2023. I figured where there is smoke, there is fire, and the issues have gotten bigger and bigger to the point where the company has actually made some pretty significant moves this quarter in order to prepare for the further potential AML issues moving forward. So I figure I go over the quarter, give my insights, kind of go over whether I think the company is a buy right now, and just overall speak on the bank's quarter. As always, everybody, 3 stocks in the description below, some of my favorite options for 2024. Just head down below, sign up for that. And as always, like the video, subscribe to the channel. Let's dive right into it. So TD Bank, they've had a very rough go of it over the last while. I mean, we can look to actual returns from TD over the last bit here. We can see that, over the last 3 years, the equal weight banking ETF, BMO's equal weight ZEB would be the ticker. It contains an equal weight position in the big 6 banks. That's up 30%-ish, 29%. Meanwhile, TD has lost 11.69, and you're going to notice in this chart where things effectively start to separate themselves from the pack, where TD separates themselves from the pack, and that would be in the latter part of 2023. And what happened in the latter part of 2023? Well, there was a lot of news that the anti-money laundering situation was going to get much worse than expected for Toronto Dominion Bank. When the company first announced the news, it was actually in the early to mid part of 2023 when they first announced that they were being investigated by U.S. regulators for anti-money laundering policies. So that kind of, analysts predicted, hey, it's not going to cost TD much more than, $250, $500 million. Shouldn't be all that big of an issue. Then we head into, 2024. Analysts start ticking up their estimates. It's going to cost a couple billion. It's going to cost this much, etc. And then we hit the point where they're like, wow, this is actually going to be considerable. It's going to cost the company anywhere from $3.6 to $4 billion. And that is what TD Bank ended up setting aside. So then we can see from 2024, TD effectively went nowhere, late 2023 prices, whereas ZEB, the banking ETF, has gone up by quite a bit. And the one issue with this is the company's assets have been capped by U.S. regulators, and I'm going to go over this in this quarter, what this means for the company and what they've had to do recently, but let's dive right into this. So U.S. AML remediation. So a lot of people, they initially said, this isn't going to be that big of a deal. They're going to get a slap on the wrist, a fine. They're going to be able to move on with it. The company's going to be fine. I'm buying the dip. And then for a short while, it looked like they were right. I mean, we look at TD back here in June of 2024, $74. Then we get up to $87. And, I did get a lot of flack over this time period because I have been a general bear of TD Bank since I sold it. And they said, hey, this was a slam dunk buy on the dips. But I mean, we fast forward till now, it's cratered all the way back to that price. And I believe people are really underestimating how long it is going to take this company to deal with these anti-money laundering issues. This company has a remediation plan put in until 2028. So this is not something that is going away anytime soon. I mean, we're close to 2025 right now. So you're talking 3 years before this company is going to be able to fully implement the processes that U.S. regulators are going to want to see. So if I were to guess, I would say that asset cap on U.S. assets is going to stay in place at least until 2028. I mean, we see something like Wells Fargo, they still have an asset cap placed on them from things they did a decade ago. I mean, the asset cap wasn't fully placed until I believe it was 2018, but still, you're talking 6+ years and they're still capped. So when we get into the quarter, we're looking at adjusted net income of $3.2 billion, earnings per share of $1.72. We see pre-tax, pre-provision growth. This is what PTPP means. It actually declined. We're looking at total assets of around $2.1 trillion, and return on equity, we can see it's continued to fall in as well as the company, they continue to deal with a ton of issues. So the one thing I really want to highlight here, and the one thing that is really key, is the company has actually suspended its guidance. Now, not all big Canadian banks issue guidance, but the ones that do, it is a rarity. In fact, I've pretty much never seen them outside of the pandemic-like situation. I mean, obviously that's a global catastrophe. Nobody really could have predicted what was going to go on there. So a lot of them, they said they might not reach targets then. But outside of that situation, I've never seen a major Canadian bank that issues guidance suspending it. So they are suspending their medium-term adjusted earnings growth, return on equity, and operating leverage targets. So effectively what they're going to do, they're going to review their operations through the first 2 quarters in 2025. As you can see here, and then they're going to reissue guidance, whatever it may be. But the one thing that TD has mentioned over the last while is that it's going to be very difficult for the company to grow earnings over the next year. They full out said this, management full out stated this, that they are not going to be able to grow earnings in 2025. So what that leads me to believe is that the absolute best case scenario for TD in 2025 would be flat earnings. So we look to earnings of $7.81 in 2024. So effectively, that is probably what they're going to be reporting in 2025. And if we go to analyst estimates and we head to annual here, we can see that analysts are expecting $7.83. So they're expecting about a 2-cent raise in earnings per share. So effectively nothing. So this bank is going to be flat over the next year as they continue to deal with issues. Now, look to revenue. Adjusted revenue is up 9% year over year. The only difficulty is expenses are up 19% year over year, which is having a big impact to earnings. Obviously, the anti-money laundering issues are having a big play in terms of overall expenses, and I do expect this to normalize over the last while, but there's no doubt that the company is facing a ton of pressure. So as a result, we look to earnings of $4.72, down 14% year over year. However, when we adjust anti-money laundering issues out, we get $7.81, which is down 1% year over year. So we see banks like Royal Bank, CIBC posting, near double-digit earnings growth, or at least mid to high single-digit earnings growth, while TD is having to adjust all of their large anti-money laundering costs out of earnings just to get it so that they're down 1% year over year. Now, I do believe these adjustments are fair. I don't expect anti-money laundering issues to cost this company, the $3.5 billion plus it did in 2024. However, there is still going to be ongoing costs. So there's no doubt going to be recurring costs I would expect through 2028 that this company has to face because of the issues they've got themselves into. Now, on the quarter, we can see that earnings per share, they came out at $1.97, up 33% year over year. Adjusted earnings, they're down 5% year over year. And when we look to revenue, it's adjusted up 12% year over year. However, most of the increase in earnings was just because they had to sell off their Schwab shares to kind of absorb the anti-money laundering fines. They needed to, sell some of their position off there to be able to afford it and to shore up their CET1 ratio. And another thing would actually be from them having to sell off U.S. assets from their balance sheet because that asset cap was so tight. I believe it was around $434 billion, and the company had around $430 billion in U.S. assets. So it had to, sell off some mortgages, sell off some commercial car loans, I believe, in order to, create a bit of a buffer so that it can still, offer new products in the United States, expand in some particular areas without, approaching that asset cap, with how tight it is. They don't want to do that. They want to create some sort of buffer. So the one positive we see here is provisions for credit losses. We're looking at $1.109 billion. So that is only a $37 million increase over the Q3 of 2024. And what we want to see is provisions normalizing. We want to see them, either decreasing. In the case of CIBC, it's actually decreasing, or we just want to see slower growth overall. And when we look to the actual provisions themselves, we can see that impaired loan provisions make up a gigantic portion of this, and it's actually performing loan provisions actually saw a recovery in terms of overall PCLs and saw a massive recovery quarter over quarter. So the main difference between impaired loan PCLs and performing loan PCLs, impaired loans are ones that have had a default, some sort of non-payment, things like that. Whereas performing loans are loans that are still being paid back by the consumers, but the bank, has a bit of an idea that it could eventually go unpaid. So that would maybe be somebody who is really, really tight financially when it comes to their mortgage. And the bank would, they're barely making the payments. They don't have a lot of savings. They're hitting, the stress point, the stress test portion of the mortgage. So they put that in their performing loans. However, we've seen interest rates go down quite a bit over the last while in Canada, which is likely giving some consumers relief. So as a result, we're not seeing as large of performing loan provisions for credit losses. Instead, they're either being moved into impaired loans, which, have a very, very lower chance of recovery instead of performing loans when compared to performing loans. But we're also, likely seeing this reduction as a result of the company not having to book that many performing loan provisions. But ultimately, from a provision standpoint, the company looks to be doing quite well relative to the other institutions. I mean, overall, its Canadian end of the business is performing quite well. We're looking at revenue, it's up 7% year over year. We're looking at net income up 9% year over year. Quarter over quarter, it's down 3%, but this isn't really a gigantic issue. We're seeing, again, a lot of impaired loan PCLs, but still, there's some sort of normalization there. We're seeing loan volumes up 5%, deposit volumes up 5%. These aren't as good a rates as, companies like National Bank, Royal Bank, but they're still relatively solid. It kind of indicates, the Canadian end of the business is doing quite strong. Where it's struggling right now, and I had mentioned this before, is its U.S. segment. So the company had to reduce its assets by 10%. So why are they doing this? They're doing it to create capacity to serve customers in the U.S. while maintaining that buffer to asset limitation, because if they get tight enough to that buffer, they're not going to be able to issue loans to U.S. customers, things like that. So what they did, they plan to sell residential jumbo mortgages. They plan to reduce their commercial auto dealer lending and other non-core portfolio lending. So as we look at this, they haven't really reduced assets all that much. They sit at $431 billion versus the cap of $434. They do plan to pay down $14 billion worth of bank borrowings using mainly cash, which will contribute to a further reduction in U.S. assets. And they do plan to reduce, get these assets reduced by the end of fiscal 2025. So they're going to, reduce their U.S. assets by 10% throughout 2025. So ultimately, this is a bank that relied a lot on U.S. growth, like a lot. And right now, they're just not being able to grow that segment of the business because of the asset cap. In fact, they're reducing it. So, we look to adjusted revenue down 1%, adjusted net income down 14%. Provisions, again, they're relatively stable. They're really not going up that much, but ultimately the asset cap is really going to hurt this end of the business. It is inevitable. So what is TD Bank ultimately going to have to do to offset this asset cap? They're going to have to grow in other areas. Now, the main element a lot of people think they can do is they can just grow faster in the Canadian market. The Canadian market is hyper competitive right now. We've got the other big players like Royal Bank, National, CIBC. They're kind of killing it in the Canadian banking segment, to be honest, and it's not going to be very easy for TD to just come in and, take market share away. So this is ultimately a difficulty for TD Bank overall. So ultimately, the company is going to have to grow somewhere else. And a lot of people have expected that it could grow internationally. But with the difficulty that the company is going through right now with anti-money laundering, I don't exactly think there's going to be a country that is, willing to open its arms and let the company into its country to operate when it's been effectively, to be blunt, dealing with criminals overall. So this isn't really a good look. So another thing that actually shocked me was the company ended up raising its dividend. So they announced a 3% increase in the dividend, and this is the only raise of the year that TD issued. Now, the one thing is if you've been following TD Bank for any amount of time, it's been one of the faster growing dividend growth stocks out of the Canadian banks. So we can see over the last 10 years, if we go to the dividend growth rate, we're looking at 123% over the last 10 years. It's grown the dividend from, we're talking 47 cents a share per quarter to 105. So this is a very, very strong growth rate, but the company came in with a 3% raise. So this raise to me is effectively just to keep the company's dividend growth streak alive. They are not in a situation where they should be raising the dividend. We can look at payout ratios. They're at 81%. Now, again, this is going to be because of the anti-money laundering issues. These payout ratios are likely artificially inflated. They're not expected to incur as much costs in 2025 relative to 2024. So I do expect this payout ratio to normalize, but I would be very surprised if we get back down to this pre-pandemic, range of 42 to 44%, which is what TD has, aimed to pay out for quite some time. If we could even get it down to 50%, I'd be pretty surprised. So the dividend raise, I'm not exactly surprised with. The company just wants to keep its dividend growth streak alive. The dividend is sustainable. I don't think it's in any situation where it's getting cut anytime soon. But I mean, obviously with the uncertainty moving forward, I would, if I was a shareholder, I would have rather no dividend raise. I would have rather the company, keep the capital themselves just in case we get some unforeseen weakness in the Canadian economy, especially with their U.S. assets capped. And just overall, I think, the dividend raise, although expected, I'm not a huge fan of it. So the company is clearly beat up. There is no doubting that. So let's look to valuation to see if the company is attractive. So we look at 15.86 times earnings, and we kind of think right now that the company is fairly expensive on that benchmark right there. But the one thing is this will be non-adjusted numbers, and the one thing you'll notice with a lot of price to earnings ratios is they are non-adjusted numbers. So what has been hit very hard in 2024, it would be TD's earnings per share because of the anti-money laundering issues. So this company is not, in reality, I mean, it is, but it isn't trading at effectively 16x earnings. It's much lower than this. And when you isolate out the anti-money laundering issues, we're effectively looking at, $74 a share, whereas their earnings would have been, I think, at the $7.30 range. So we're looking at 10x earnings, which would put it as the cheapest Canadian bank. I mean, we look at National, 12.6. We look at Royal, almost 16. Bank of Montreal, 15. Bank of Nova Scotia, 13. So adjusted earnings, and obviously we're not doing adjustments on these other banks, but they're going to have a lot less adjustments than TD Bank. We're probably looking at around 10 or 11x earnings. So it is the cheapest bank. However, I'm not exactly sure if I would pull the trigger on this bank right now just because of the issues it is facing moving forward. I mean, we're looking at 8.89x earnings, but we're also looking at earnings that are effectively not expected to grow in 2025. I mean, we're actually looking at earnings that are expected to decline in 2025. Flat, best case scenario issued by the bank. There's expected, and then after that, we're expected to grow even slower than the other institutions are. I mean, I don't really see a huge amount of value here. And I mean, again, I know we could see this short-term run-up in price, just like we did, during the summertime. However, I mean, I think over the long term, because of this asset cap, you will see TD Bank be one of the weaker performing Canadian banks. Now, this is a stock that a lot of Canadians own. So do I hope I'm wrong? Absolutely. I hope the company does great. But effectively, it's got some really big headwinds that the other banks just aren't really facing right now. And for that reason, I'm not exactly sure I would add the company. So that's it for the video, everybody. Hope you liked it. Head down below, like the video, subscribe to the channel. And again, there's a research report on 3 stocks I really like in 2024 and 2025. You can grab that down in the description.